Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Anirban, thanks for taking some time to join me, mate. How you going?
Mate, I am fantastic, or as fantastic as I can be, given lockdowns and everything else. But my hair is growing, and I actually shampooed it nicely today.
Maybe next week or the month after, you'll have a ponytail, and you can.
Well, yeah, have you heard of the term? So this is again off script, right? So a priest who goes to Himalayas is going to be known as a sadhu. So sadhu. They have long hair and long beard. So maybe I'll become a sadhu by, I don't know, by the end of November or December, whenever our lockdown finishes. The barbershops are definitely closed until then. And I'm not trying to, I have got actually instrument at home to be my own barber. But because I did that, in the previous iterations of the lockdown, and my wife and daughter were both not impressed. So,
I think I did something similar last year. How long have you been in lockdown now? So you're in Sydney, I'm in Melbourne. For those listeners who don't know, how long have you been in lockdown?
That's a great question. I am so numb to this lockdown thing that I'm probably guessing at least a month now, I would say.
I feel like it's even longer than that.
It's probably even longer than that because, like maybe 6 weeks easily.
So we're recording this on the 11th of August and it was the 26th of June, I believe.
Holy moly.
First set of restrictions.
Yeah, no, so restrictions weren't really, so there was restrictions where you could, put on a mask and still go get your coffee. Like I have a morning chore of getting my coffee from a particular shop. But yeah.
It looks like it was around that date, according to the New York Times. So yeah, you've been in lockdown for 6 weeks.
Yeah,
long time.
Long time, So I'll become a priest or something by the end of November, and then we'll see.
We've got to count our blessings here, mate, because you and I can still work from home. In fact, we work from home most of the time anyway. So
that's right.
What have you been working on since I spoke to you since last week? Has there been anything in particular?
Oh, lots of earnings. So, many of the companies that I follow closely, they have reported earnings so far, mostly very good. And there's one company called FSLY, which had really poor earnings. There's one company called Cloudflare, which sort of competes with FSLY, which has excellent earnings. Lots of earnings has been there. I've been going through my watch list, looking for what stock to recommend next month. And that's a process. What happens, like unlike many, so in 7 investing, different people have different styles, which is always interesting. And I have like 20 stocks easily, maybe 25, actually 30 maybe on my watch list. And every month I find it like picking one which I really have the highest conviction is a challenge, because if somebody told me pick 30 stocks, I can actually do that. That is easier done than picking one. So like I look at my list and I have a back pocket rec, a couple of back pocket recs, which I think are like, fantastic, market beating ideas. But probably, maybe more well-known. And I try not to go for a well-known name. That's been my thing. My thing is that, a well-known name sometimes to me seems like, I can say, well, go buy Apple, but that's a little bit of a cheating. I find that's a little bit of cheating, because a lot of people who subscribe to, stock picking newsletters want to find something a little bit maybe underfollowed, under the radar, mid-cap type of, growth opportunities and things like that. But, that's what I personally think. That might actually be completely untrue what people expect. And then again, of course, in the gamut, we have seven folks picking stocks, and we do pick some, more more well-known and established names that we think are market beaters as well. So I just try to, yeah. So anyways, it's a process. So that's what I've been doing. I think narrowed it down to maybe top 5 thus far, and then we'll see from there. So yeah.
What you said that Fastly had performed poorly during the quarter and Cloudflare performed well. Is for those who don't know, these are 2 content delivery networks, which also kind of teeter on the edge of cybersecurity as well. So what was it, because Fastly's network went down? Is that the big reason?
Yeah, so that's a great question. So Fastly, so both of these companies have some similarities and some differences. So Cloudflare is like Fastly, a content delivery network, but it's basically it's a really difficult company to explain, largely because what they do is they provide security, performance, and reliability services. So if you are actually a corporate and you want to run a network, you could actually have your network run through Cloudflare. If you host a website, your website could be hosted by Cloudflare and protected by Cloudflare, right? Then if you want zero trust security, you can actually also go to Cloudflare for that. Then if you wanted to have edge computing, basically like you want to do cloud computing but at the edge of the network, then you can go to Cloudflare. So Cloudflare does a bunch of different things, but they also do content delivery. Fastly is basically a content delivery company with edge networking component. So you could do some edge computing, cloud computing at the edge using Fastly. So that's where their similarity. So I think, yes, so Fastly's network was down. Large parts of the internet were down because of Fastly. That spooked some of their users. So I think of the top 10 users, the top 10 clients that they've got using their network, one of them hasn't returned. And although it seems like it's going to come back, traffic is down from the others. Now that might seem like an oddity, like, how can traffic be down? Traffic can be down because suppose I'm a company like Amazon and I need content delivery services. I might use Fastly, I might use Akamai, I might use Cloudflare, I might use, because everybody has a multi CDN approach, right?
Yeah.
So then what happens is that because, maybe they're not feeling good about something, that they can divert traffic to the other ones, right? So the Fastly is feeling the pinch of that. And of course, then they had some slowdown in acquisition of new customers. Yeah, so Fastly has been having what I would call execution challenges for past few quarters, in my opinion. I still do own the stock, so yeah. So, but that's my thing. If I bought something, I'm really slow to sell. So and the reason behind that is, it sounds odd, right? Why to hold a stock that's underperforming? The problem is that you never know it is underperforming until it has underperformed, at which point you think it is cheap. And it doesn't mean that it can't become cheaper. It can, right? But then on the other hand, if you look at volatility of companies, fast-growing companies, many fast-growing companies have, or many innovative companies have had huge pullbacks. Like even a company like Apple, for example, which is like a huge company, it has had 25, 30%, 35% pullbacks from its all-time highs. A company like Netflix has had 75% pullback, right? A company like Amazon has had 90% pullback from its all-time highs. So that's one of the reasons I try not to get too spooked out. Your position already becomes small when it has pulled back that much. But yeah, I mean, right now it's having some serious execution issues, but it's got some big clients. So
it does, and I think that's one of the things that Fastly's done differently to Cloudflare. Cloudflare's had a lot of the medium sort of enterprise market. Like we use Cloudflare as well on our side of the fence. We use Cloudflare, but on our cloud providers side, they use Fastly. So it's like a multi-vendor, multi-CDN approach. And so our website went down when Fastly's network went down, not because we chose them, but because that was what the hosts were using.
Yeah.
Which is it was really interesting. I was looking at Fastly during the pandemic and like the first outbreak, and I was thinking, this is a really interesting company. It takes a bit of time to get your head around it because of what it does. But at the time, I thought it was the more attractive one of the two, being Fastly and Cloudflare. Fastly is now, according to Google Finance at least, which we know isn't always accurate, a $5 billion company. Cloudflare is nearly 40 billion. So how the times have changed. I wonder if they would be eyeing them off.
Yeah, like, here's the thing, right? So I think Cloudflare is as I said, difficult company to understand because it's not. So I think, they would describe themselves as they're not really a CDN.
Yeah.
So they're basically CDN for them is an afterthought. What they do really well is denial of service attack prevention. They,
they're
if
really
you
good at
have
that.
if you have a site behind them, they can do performance management, right? So basically they'll scale up they'll scale up or pop up more servers for you, which allows your site to scale. They do those things very well. Their edge computing platform is really good because that they've used that to build like this zero trust solution. So if you're a company, you can use Cloudflare's Teams software, and then you basically have access to a zero trust sort of secure end-to-end thing. They even have a wrap protocol for for your mobile phone and stuff like that that you can just download and use. So it's basically a DNS service. So I think it's a little bit of a complicated company. It's also a fast-moving company. They innovate very, very quickly. So what else? There's an intro. Okay, I'll stop here because I think we've gone completely off script now.
Okay.
So here's the thing about Cloudflare. So Vendrock was one of the early founders, early venture capital investors in Cloudflare. Okay. There's another company Vendrock had funded, one of the first, I think, funds that they're in, that was called Apple, right? And they made, I think, a lot of money on their Apple, but they've actually made a lot more on their Cloudflare investment. So that's a little bit of a Cloudflare. There's actually, if somebody has time, they can read the Cloudflare script. There was a question, because of Cloudflare's network and some of Cloudflare's technology is being used by Apple for this Apple private relay thing that they're doing. So there's a question about, okay, how's that going? But, because anything that you do with Apple, you have no, Apple probably has got you a confidentiality document that you can't say. So instead of answering that particular question, the CEO, Matthew Prince, basically told them about Vendrock, their history with Vendrock, then his history with investing in Apple, and how his Apple shares paid for his Harvard Business School and founding of this company. So there's a little backstory there, what I call a perfect non-answer.
Okay, that's great. So those two companies, Fastly, FSLY, and Net, which is that's Cloudflare on the New York Stock Exchange. So just before we get into it, we already are into it. You can join us on Twitter at 7A Mahanti. You'll find the link in the show notes to catch up with Anirban, and myself at Owen Rask. It's at OwenRask. You'll find both of us on Twitter. So join the conversation, say good day, suggest some future topics for us. So there's a couple of things that we'll get to just in terms of company results, a lot here on the ASX, but also some other stuff that we've got prepped. One of the things I should just say that I've been working on, I've been looking at Fastly or Cloudflare, but though I should be by the sounds of it, mainly just preparing for ASX reporting season. I think we're kind of fortunate here in Australia. We can look at a lot of the US reports, have about a week or two, which is where we are now, and then go into the ASX, the thick of the ASX reports. But this week, Wednesday, the 11th of August, we have actually started to see some ASX companies drop some results. And one of those, which we'll get to in a minute, is CBA. We've seen ELMO report as well, and a few others. But before we get to that, mate, I just thought I'd ask you, what are some of the ways that you prepare yourself for reporting season? Because you said you have 30 companies on your watch list before. How do you keep up? How do you manage? Do you do anything in advance that maybe other investors could do too to get on top of their portfolio?
So I don't do anything specific. So if a company, so as I said, I have 30 companies on my watch list, but most of those companies probably are companies that I already own as a portfolio in my own portfolio or portfolios. So I know them pretty well. One of the advantages of, so here's the thing I can suggest to, mostly this is for newbies. Most people don't listen or hear a conference call. That can be actually very, very useful, because it just the tone of the answers, it tells you a lot. And I think I suggest to people that you should listen to them. It also is an opportunity for you to learn from management how they're thinking about the company, right? So this is, I think, a great. And actually for the ASX, I'll say it's doubly important, because many ASX companies do not produce like a good half-year report where you can get an understanding of what the business is. But you can get a very good understanding of the business by actually going to the conference call, listening. And here's another advantage. This is an ASX only advantage. An individual investor can actually ask a question on an ASX conference. For most of them, especially the mid cap to small cap ones, you can. I don't know about the large caps. I don't think you can ask a question to the CBA CEO, but you'll be able to ask to the ELMO CEO if you wanted to, right? And I think that's an advantage because that's an opportunity for you to ask questions. So that's what I would say is to get on to the conference calls and then make notes. And you'd find it's like studying, right? It's like studying for physics or chemistry. You know, the more you study, the more you learn about the company, the more you study different companies, the more you learn. Okay, I can compare this with that. And it's just that really. I don't know, there's no secret sauce except that, you know, the more studying you do, the more you learn, the better you get at identifying things quickly, right? So, you know, what takes me now maybe 20 minutes used to probably take me 1 hour, maybe 10 years ago, right? So now I can sort of look at, okay, this, and this. I can say, boom, okay, this is out and this is still in my watch list. So you get better at yellow flags.
I always find that obviously you got to do the work before the results. Sometimes you can, our job, both of us, is to find market beating investment ideas, and results season is a good time to do that. But oftentimes it's pretty hectic trying to keep up with what you already have. But obviously you got to do the work in advance, is what I mean to say. So, you know, if you're into modeling and doing all that, you do that in advance. And the way I think about it is that I try and identify the 1, 2, or 3 variables that I believe are most important for every company. So whether that's a company's customer acquisition cost, or whether it's ARPU, average revenue per user, whether it's the retention rate, which we'll get to in a minute, all of these things, I try and identify the 2 or 3 that are most important in advance. So then when it comes to the day, I can go straight to where I expect the numbers to be and be like, okay, bang, didn't hit expectations or my expectations. This did, this didn't. There's my checklist, and then I can focus more on actually then taking a step back and actually reading through the report. But I've heard in the past a lot of investors talk about, you know, it's really important to be prepared for results day, and you've got to act fast if you want to make a position, things like that. And I think that's totally the wrong approach. I don't think I've ever made a decision based on a single quarterly report or half-yearly report. I guess that just lends itself, like we're long-term investors, right? Like you said, slow to sell before. I'm extremely slow to sell, and that served me very well. So I guess I don't really buy into that, but I just do like to manage my time effectively as I can. So having those 2 or 3 variables in advance, you might only just write them down on a piece of paper. You know, if we're talking about a company like Apple, it might be iPhone revenue, Chinese revenue, and maybe installed base. If you get any of those 3 variables, maybe you're happy. And that's just an example, but I try and do that for all the companies that I cover. Okay, so here's an interesting one for you. I think we're going to maybe just jump straight into a company here, which is a company called ELMO, which I know you're familiar with. You were tweeting about it the other day too. Can you maybe just start off like what ELMO does, just in simple terms, and then the result, and then maybe we'll look at something that you wanted to talk about for software companies in particular.
Cool. So given that, you know, we are on Zoom, right? I could actually do a screen share again. What do you think?
Yeah, let's do it.
Let's do that. Okay. And, you know, pardon me if I get some of my, you know, sometimes, you know, during lockdowns, I'm actually going to try to do this. I'm going to have do not disturb for 1 hour. Hopefully that will stop all those messages pinging me, but I'm going to do a screen share and let's see what happens. Oh, disabled by the host.
Oh, again,
Owen likes to have a tight leash on me so I don't share wrong things.
Here we go. Let me see what I can do here.
Yeah, so I'll keep talking about ELMO. So ELMO is basically a human capital management software company. What that means is helps with, you know, if you want to maintain leave allowance, you want to know how to recruit people, how to keep people. It's an HR software, right? Along with that, they have a payment tool associated. So if you've got payments and human resource management that typically any medium scale to large scale company would need, ELMO basically sells its softwares to mostly the mid-market, they call it. So not the large enterprises, but smaller than that. So I think this is like 1,000 people or less is how they would describe it. But they've gone actually down market as well for really the small companies. And many of these companies would be people that would be serving their human capital management needs either using spreadsheet or paper and pen, right? So there's that. So it's a very interesting niche space that they work on. But yeah, and it's an interesting company. So let me share my screen. And,
yeah, so I noticed they've got while you get the sharing up, I noticed that they've got Breathe, which is less than 50 employees, and they've got the ELMO mid-market solution, which is 50 to 2,000 employees. So they've got those two businesses.
Exactly. So it's basically small to mid-market, right? So this was the results. The results, so number one thing I want to talk about here is many times we'll see that the annual recurring revenue, in this case, this is about 84 million, let's call it. That's a 52% growth at a headline number that looks really good, but the ELMO is very acquisitive, right? So they acquired a lot of, so the growth is acquired with this. So below you see that say 26% organic ARR growth. That's pretty good. Revenue is still trailing about 69 million versus 84 million. The revenue is trailing because, the ARR, you sign new customers, they haven't yet, paid maybe for the full year, right? So, it's still trailing, but, it will eventually at long term will start to sort of mash up together. They're running at break even. It's on an operating profit basis. So there's good, a lot of cash on hand. So 82 million cash on hand. Again, remember, this is acquisitions. If they buy a $50 million company, they would get rid of all the cash that they've got on hand. But 82 million cash on hand is pretty strong. Ignore everything else that we have just talked about. This Breathe, and so Breathe is a company out of the UK. They now have sort of. The thing that I wanted to talk about is this is, and there's a TAM. The TAM is, pretty large if you think about it. And I think this is a niche space where the big enterprise, the American software companies are not going to really compete because this is a really hard market to compete in. So if they do a good job, they can, occupy a decent chunk of this market, less than 5% penetration, less than 3% penetration. The thing that I wanted to get to is, one of the things that annoys me about this presentation is that there's a lot of details. They show you, for example, in this particular slide, the organic ARR, and you get the churn number here, right? So you look at this. This is interesting. If you look at the churn in dollar terms is $7 million, right, on ARR. So they started with 55 million in ARR, out of which they lost 7 million. That's a pretty big number in terms of loss, because what typically happens in a great software company, the churn on a customer basis might be less than 5%. But the churn on dollar basis, which is basically, if you look at the total dollars that you're getting from the customers you have this year that were customers last year, you'd pretty much have more dollars from that set of customers. So what that's known as basically dollar-based retention. Yeah. Right. So, and the dollar-based retention being more than 100 suggests that those people who you retained, they're actually spending more with you, which means there's a great product market fit. And that actually is not, I think that's one thing that these guys are not achieving. Now, there's one reason for that. And this is one reason I think is the reason. And that's because they operate in the SMB space. So there might be less opportunities to upsell, right? To sell new modules. And there's always this thing that, during the pandemic, for example, a lot of small businesses have been hurt. They might have to cut costs. Maybe some have closed down. So there's churn. So churn's levels, because there have been instances where the dollar-based expansion rate has been above 100% for this company. But, and here's the thing, right? It's taking me a while to find where that number is because that number is not good, right? So it's on slide number 13, where the net retention on a dollar basis is 96% for ELMO, and the customer retention rate is 84%. That is, stunningly low in the sense that 85% is probably very similar to what Xero had. So it's basically suggesting to you that you're getting that type of customer base, but the net retention number being less than 100%, that is worrying in the sense that it means that you are really fighting hard to keep your customers, right? Or at least on a dollar basis. And the funny thing with net retention rate in a dollar-based net retention numbers are, this has an exponential curve to it. So 120% might seem like, well, it's only 20% more than 100, but it actually has an exponential difference, because every year, if you're able to do that, then in like 10 years, 120% is going to be substantially better than 100%, because every year you're able to add that 20%. So I think this is probably my only big red flag that I had.
And for context, what would be the type of company that you've come across that has a really good dollar retention rate? Like, is there?
Yeah, so like, so I'll give you an example.
Global?
Well, so I'll give you global examples because they're off the top of my head. So completely class leading dollar-based net expansion numbers is a company called Snowflake. So it's a data warehousing company. That company has 140, 150, 160% net retention rates. A company like Cloudflare that I just talked about, that reports net retention rates above 120% regularly, has done for several quarters. So 140, 150 is like really class leading. By a few companies at 120% is quite, to be called a tier one, in my opinion, but again, I want to caveat that by saying that is enterprise software. And when I say enterprise software, I mean companies that serve large customers or larger customers. But here it's interesting to think about the fact that, a company like Cloudflare does that, because Cloudflare also has many small customers.
Yeah.
Right. So it's still getting 120%, shows the strength of their larger customers that they've got, but also the fact that, they're just, running a better, tighter ship. So again, that's the thing. ELMO's number has been in the past at greater than 100. So maybe this is a pandemic effect. I wasn't on the call to say that. But anyways, I thought this is interesting. But I'll caveat by one thing. The stock looks really cheap otherwise.
Interesting. Yeah. So the thing is, right, if you looked at Cloudflare's numbers, you'd probably see the customer retention rate lower if they do have that tail of small customers, because they're going to churn more often, right? Whereas the larger enterprise clients, they're going to stay with their CDN or their, cybersecurity stack, if that's what they've been using for years and it's worked for them. So I think, I guess the clues that these things give us, the signals that they give us, are just as important as kind of what the numbers actually are. So understanding why ELMO had 6% churn, and also understanding its growth strategy to acquire in the past. ELMO's strategy is kind of not, it hasn't always rubbed me the right way. So I think that's probably one of the hesitations I've had in the past. But and it's also a very competitive space in that there are many companies that do serve the lower end of the HR or HCM, human capital management market for software. I mean, just even here at Rask, we've trialed, I think, 2 in the last month, right? And each of them would be fine. It's just about choosing the right one. So it's interesting. Yeah, right. So the company that we might also just have a quick look at, which is going to be completely the opposite end of the spectrum and very, very boring for most people. But for some people who like income, it's Commonwealth Bank. So what I might do is I might share my screen with you, seeing that I can do that now. And I'll talk along for those of you who are watching, or sorry, listening. You can still play along. So here we go. We've got Commonwealth Bank's annual report. So this is a huge report, right? This one itself is only 8 pages. This is a summary, but I'll just take you through some of the things that I look at from a high level when I'm looking at a result like this, and we can go through. The first thing is obviously loan impairment expense, given the environment. You can see it. It's like at the top of the page here. For those of you who aren't watching, it's at the top of the page. It's right next to profit. We can see profits well up. CBA has made a bunch of divestments over recent years, and obviously cleaned up its game insofar as since the 2020 recession, you could call it here in Australia, things have improved really well. And I guess one of the things that we like to see from Australian banks in particular, because they are so leveraged, is this number here, which is the net interest margin. So you can see that CBA's net interest margin is 2.03%, or if you're a finance guy or gal, it's 203 basis points. That was down 4 basis points, which isn't the end of the world, but there is a trend that's happened in Australian banking for the better part of the last 20 years, which is a fall in net interest margins. And typically that's associated with a falling interest rate environment. So as interest rates have come down, the profits that banks make on the lending activities has come down too. We've seen many of the banks here in Australia face regulatory pressure, so they're even more dependent on this net margin, whereas in the past they might extract fees and have non-core business units like insurance and financial advice. We can see that CBA here has grown above system in all of its key targets. So we've got business lending, home lending, and even deposits. I think 73% of Commonwealth Bank's business model or capital stack is actually term deposits, which is, I believe, is well and truly the highest of the big 4 banks here in Australia. And why is that important? Well, that helps it maintain a wide net interest margin compared to its peers, which rely on wholesale debt markets, which can fluctuate depending on things like bond yields and currencies. So here on the left-hand side, again, we can see business lending was up. I'll just maybe add one more thing on this, which is that if a bank in an environment that seems very growthy is growing faster than the system or faster than the market, that might sound great, but it's not always a sign of a great bank, because it can mean that it's lending ahead of the curve or its lending practices aren't quite up to standard. So you don't want to see a bank come out and just race out of the gates necessarily, although 3 times system for business lending for CBA is quite fast, in my opinion. We can see the dividend came up, and this is interesting, and this is probably where the last 2 points are probably the most interesting for all listeners. CBA's final dividend was $2 a share, taking the full year to $3.50 fully franked. I guess the bigger thing for most investors was actually the buyback that was announced, which was above expectations, which is $6 billion. And not only that, they're buying back shares, or they want to buy back your shares for more than what you can sell them for on the market, which is interesting too. So the dividend is important, in my opinion, because that's how we arrive at a valuation for Commonwealth Bank. So I just tried to stick Commonwealth Bank's, just very quickly before we jumped on air, tried to stick Commonwealth Bank into a dividend discount model. And I had to really push it to get it above $100 valuation. And when I say push it, I mean you're dropping your discount rate below 7%, which, depending on your outlook, is maybe a fair expected return or not. I don't know. Obviously, the dividends for all banks are down since before COVID. Whether or not they come back to that, I don't know. They're targeting, I think it's 70 to 80% payout rates. But the reason that this is important is because when we look at the buyback, the $6 billion off-market share buyback, I want to see a bank do that when they believe the shares are cheap. One of the problems that CBA has, I believe, is that they can't, like most of the banks, can't really deploy $6 billion of capital effectively. It's pretty hard for them here in Australia to deploy $6 billion. Even if you say, go out and innovate, what can they do with $6 billion here in Australia? Not that much, to be honest. So I just thought this was an interesting thing. It's an interesting report. Obviously, CBA has been the cream of the crop for over 10 years now. It was one of the banks that kind of held fast during the 2020 setback. And I don't know, mate, I don't know if you have any insights here, but just to recap, some of the things that you'd look at for a bank, obviously, if you're looking for dividends, you'd look at dividends, but the net interest margin, you'd want to dive into why the net interest margin is held up. Loan impairment expense, still really good. And that's really it. Like for me, for a bank, if I'm going for a quick glance, that's what I'm looking at. Deposit funding, again, was really good for CBA. They made a bunch of divestments. So I don't think there's much more to say, even though they've taken, how many pages? 312 pages this year. So we won't go through it all, but that's my high level look at CBA, mate. I don't know if you had anything to
I love it, Owen. I'm going to ask you questions instead of.
Yeah, sure.
So here's my question. Question number 1: what's the bear case, right? So I'll give a bear case. So for CBA to make money, basically the net interest margin basically means the net interest margin is a very interesting concept, right? So they basically are borrowing they're borrowing money from someone, which could include the depositors, right? So any fund that sits with them is basically a liability. And they pay nothing right now on those term deposits. Then they borrow money at nothing, and then they give out money and make something of it, right? And of course, as the interest rates creep up, they are able to make more on the difference. So, right now their liability is actually pretty cheap, which is a good thing. Now, the bulk of the money that they make is of housing, right? And housing market has been super hot. Very counterintuitive, but has been super hot. At some point, this housing market has to cool, or even, I'm not even saying crash, pull back. I'm just saying it has to cool down from its exuberance, right? If there's somewhere that it's tulip mania, that's how I'll call it, the housing market.
But it doubles every 7 years or every 10 years, isn't it? So...
yeah, but at this rate, the problem with the housing market is that at that rate, no Australian is going to have any house because they'll not be able to afford it. Mm-hmm. or let me put it this way: no Australian who doesn't have a house is going to ever have a house. They might as well go to the moon or Mars and build a house there. They'll get a big backyard as well there. So they should buy a ticket on Virgin Galactic or SpaceX.
It's about the same deposit, I believe.
And it's the same deposit. So what's the bear case? If the housing market cools off and doesn't result in mania making money for the banks, isn't their cash profits going to pull back significantly?
Yeah, of course. Yeah. And that's the bear case, right? So, but that's been the bear case. I think the thing is, that's been the bear case since 91, since the last recession, right? And I'm a bit like, it might sound facetious, but it's true. Like it is, it's been the case for a long time. Yeah. And yeah, I mean, I've often thought to myself, and this is probably going right back to like the Greek, debt crisis, where I was thinking, geez, how's this thing going to play out for Australian banks and global wholesale markets and everything? And I've thought to myself, this is not good, because the rate, even if nothing really changes here in Australia, the lending markets could become tight, which pushes up rates. And we haven't really seen that happen. The banks have managed that very well, especially Commonwealth Bank. I think the big things that you'd be mindful of is that kind of that thing that just eats away in the background, which is a lot of dilution. Some of the big banks have been robbing Peter to pay Paul in some ways. They've been paying dividends while also issuing stock, which it sounds great because you get the imputation credits, but it's something, if you're a long-term compounder, you want to see both of those things. You want to see dividends and growth, if ideally. I'd say, there's the implicit guarantee. What was it? 6 basis points is what the government levered on these big 4 banks, I believe it was. And that's effectively their insurance, right? Because the idea is that if the banks go out of business, we've got bigger problems than just what's going on with Commonwealth Bank. And so there's that implicit guarantee that they would always be rescued. Now that I want to have a big asterisk around that, just wrap something around that, which is that just because that's the implicit guarantee, air quotes, doesn't mean that you as a shareholder are going to have a guaranteed return. So, we would just see the equity fall out straight out the bottom of this thing. I think, I can't remember the exact number. I should have prepared it, but, CBA is leveraged in the high teens, I believe. So if you think about that, there's not much that has to go wrong for those margins to compress and the profits to quickly evaporate. So I know that's not really a direct way to say it, because I don't think there is an answer specifically for it, but generally speaking, you would want to be prepared for that. And it all just comes back to, if you're going to buy a company like this, in my opinion, you buy it when it's below your estimate of fair value, because that's the most sensible time to do it. And it's pretty easy business to model from a growth perspective. I had Mary Manning on the podcast many years ago, and she summed it up really well, which is that when you look at a bank, opportunity is on the income statement, looking at those net interest margins, trying to forecast how much income they're going to bring in. But risk is on the balance sheet. How are they accounting for losses and provisioning for that? What's their capital adequacy ratio? The banks are pretty good here in Australia, in my opinion. That doesn't mean that they're safe, but it means that they're pretty good. So we have a pretty well-run and regulated financial system. That's my very boring bank answer for you. I don't really have much more to throw back at you.
No, I appreciate that. Yeah, no. So I would even say that it's not even the doomsday scenario. Like I'm not saying the banks are going to go bust. I just think that if the property market cools, then the bank's earnings are going to be hurt.
Oh yeah, even if they go sideways, the bank's
Yeah,
earnings are going
are going to hurt.
Yeah, yeah.
So I have a rule of thumb for probably I'd never hit it because I'm not a bank buyer anyways. Like I say, buy them when their PE is like 10 or 12, sell them when their PE is 18 to 20.
Yeah.
Right. And they're probably right now around that PE of 18 to 20. Another way to do that is to look at the price to book.
Yeah, price to book. Yeah.
The price to book. And Australian banks Australian banks are very similar to like Canadian banks. They've tended to trade at a much higher price to book than say an American bank would.
But the American banks have wider margins too. So you get them cheaper and they tend to be more efficient banks as well.
The more efficient bank, but there's more competition as well in the American market.
Yeah, there is. Yeah.
In banking. So, I mean, anyways, interesting stuff.
You know what? Can I just give you one more? I'd probably bear case that not many people are thinking about is the rise of neobanks in Australia and the open banking initiative. I don't think enough investors who have a 10 to 20 year horizon are paying enough attention to those banks. If I look around me and a lot of the people that I know, they're banking with banks like Up Money, banks that are typical classical neobanks where you get good interest rates, you get great apps, you get great technology, you can transfer your data around, it's secure, it's seamless, you don't need a branch. So maybe they're going to play a bigger role in terms of competition than some of the HSBCs and the INGs that have attempted to come into Australia. Maybe that's something to be mindful of as well.
I was going to make a joke. I was going to say that, all the banks, they like to make fun of, buy now, pay later. But, the greatest buy now, pay later or buy now and pay never is actually buying property. So,
you have to be careful with that one.
Yeah, well, it's effectively buy now, pay never in real, like, when you're buying a $5 million property, you could pretty much continue living your entire life. And then at the end, when you die, you still probably have debt. So it's buy now, pay never. So, I tell the banks, stop making fun of Afterpay.
That's great. Actually, that is we talked about PayPal. It's not just neobanks, right? We talk about Apple Pay, PayPal, Square, all these businesses in the last few weeks. I think it was, I don't know if it was Matt Coleman or CBA CEO or before that, Ian Narev, who basically identified Apple Pay as one of the major risks to their business model. Not necessarily straight away, but a decade or two down the line, what does that become? And they're still throwing their arms up in the air saying this isn't right. How can these businesses, do this? And it's funny when I guess it's on the other hand. One more company thing before maybe we get to these personal finance things, mate. A lot of you and I spoke off air just a little bit because you've been in lockdown for so long and I'm still in lockdown. Is Moderna shares jumped 17%. And this was an interesting announcement. Maybe I'll throw it over to you to explain why it may or may not be exactly what people think.
Yeah, so if the headline says Moderna shares are up 17% because the Australians have approved the use of Moderna vaccines or whatever number of vaccines we're buying, well, the only thing I say to people is, we're a small population, right? Buying that many vaccines. And even if we buy, so the way we have our Moderna purchases, there's a certain number, I believe 10 million or so doses, the numbers, I might get the numbers wrong, but you're getting a smaller number of doses this year, which are for the current vaccines. So the double dose vaccine that Moderna has is very similar to the Pfizer vaccine, Pfizer BioNTech vaccine. And then what we have basically committed to is we have basically an option to buy, 25 million or 30 million or 40 million, some ridiculous number of booster shots or whatever is the 2022, 2023 vaccine, right? Now, the interesting thing here is that those booster shots have not been approved by the FDA. So FDA is, the federal, drug approval agency in the US. Mm-hmm. And there are these trials that are running right now with the variations. And okay, so let me backtrack. The why booster, there's speculation right now, and I call it speculation that because there's speculation that over time, virus efficacy of vaccines against a particular virus decreases with time. The immunity wanes, right? Mm-hmm. Now, this is just an assumption. because we haven't had this thing for that long, and we don't really know. We don't have the data yet to show whether or not it does. And there's some data that says, oh, for example, there's some data from the Israeli Health Ministry, which seems to suggest that against the Delta variant, for example, the efficacy is really poor. But then there's data which has been published in New England Journal of Medicine from the UK, which seems to suggest that both vaccines that we are using currently in Australia, they actually perform very well against the Delta variant. So both the AstraZeneca and the Pfizer. So the UK data, and it's a study based on health professionals who have been vaccinated using both of those vaccines. And there is a slight reduction of performance with respect to the Alpha variant, which was in the UK, versus the Delta variant. But whether or not we're going to need boosters, I think it's a complete open question. In my mind, I read a paper. Actually, I didn't really fully understand the paper, but I'm a science guy, but I'm not a virology guy, and I'm not an immunology guy. So I read a paper in in the journal Nature. And Nature is a very high. So the only thing I know, which I can use as a filter. So one of the things that I can do, I guess, better than maybe some others, is I'm good at filtering what I call the sources of information, right? Because I know that the Nature as a place is a very difficult place to publish information, because it has a very high standard of review. It's one of the hardest places to get in. And it's of course one of the highest impact factors if you get your work published there. So this Nature publication, at least in an abstract fashion, was basically saying that if you have an mRNA shot, which is the Pfizer or the Moderna, then you shouldn't need a booster. Now, I think they also, my guess would be, cannot definitely say this because you don't have longitudinal data, but there's some scientific reasons behind why you shouldn't need a booster, right? So that goes back to this thing about Moderna. So Moderna has been doing some studies with some variations, and one of them, I think, is showing one of the boosters is showing a higher level of side effects, and therefore at whatever 10% side effect chances, and which is or hospitalization chances, something like that. So effectively, my guess would be that booster has a low chance of being approved for general use, because we don't know really whether we need the boosters or not. There's these risks associated with giving the booster. So who should get those boosters? Maybe immunocompromised people would be approved to you. So I think 17% increase because Australia and many other people are ordering options for boosters, but we don't know whether we need the boosters and whether or not those boosters are going to be approved. So I don't know, maybe that's a market really getting ahead of itself, right? In terms of, because market is saying, oh, Delta variant, Lambda variant, Peru variant, God knows how many other variants exist and what they're going to do. So in some way right now, I think the vaccines are working well. Whether or not the vaccines work over time is, I think, a question that is open. I think it's an open-ended question, although there's some science that says maybe it works. So
hopefully it does. Yeah, hope is an investment strategy, but hopefully it does, because we kind of need it to, right? So
yeah, this is one case where we would be happy if the pharma companies actually didn't have to make extra money. You know what I mean? Of course, the pharma companies, of course, they say that it is in their interest that they can make variations and little variations and whatnot, right? So there's a lot of other things that again, a company like Moderna has a lot of other things that it could do with mRNA. So there's mRNA work already going on with, for example, for flu, the normal flu, right? So the flus that viral vector vaccines, they could be mRNA vaccines as well. But yeah, so there is a financial incentive for pharma companies for having boosters. You should keep that in mind. But at the same time, I mean, I'm not making light of this. I think at the same time, I trust that they'd have to run a trial. FDA would have to approve it, and FDA has very high standards for approving. Their trials are really rigid, and things can be knocked back. And emergency approval is different versus non-emergency approval, right? Because in many ways, you're post-emergency now because the vaccines are there and they work. And there are like multiple vaccines. Like, there are 3 in the US, there's AstraZeneca here, and there's a bunch of others that exist. If you consider the Russian one, Sputnik, there's an Indian one, Covaxin. At least there are like 8 or 9 vaccines that we know works against what currently exists.
Mm.
So it's no longer an emergency in that sense. We should be producing more of these.
Mm. I read a Market Watch article on Moderna to bring it back to investing. And the article is Moderna's stock price is ridiculous, says a Bank of America analyst. And he goes on to say that while Moderna's COVID-19 vaccine has been a major contributor to the global recovery, in order to justify a $200 billion valuation, one would have to assume two things. Moderna would deliver 1 to 1.5 billion doses of its COVID-19 vaccine each year through 2038. 100% probability of success for the company's entire pipeline, which includes 4 programs in phase 2, 10 phase 1 programs, and 8 preclinical programs, not yet in human testing, for peak total sales of $30 billion. In comparison, Moderna has recorded total revenue of $7 billion over the past 4 quarters. So this analyst has a stock price target that's 75% below the current price. So maybe, I don't know, either he's an outlier or the market is justifying a 17% rise based on 25 total orders, I think it is, for Australia. So, yeah, I mean, I don't know how to make heads or tails of that one, but.
Well, I don't know much about Moderna, but I have some ideas for Moderna. They can do a stock split. Maybe that'll help them. Maybe they could just, they could list on multiple exchanges. Maybe they could, fork off a portion and list it on the ASX. And then fork off a portion, list it. Do a few other things. You can do other things other than just make boosters. I don't know. Yeah, I mean, I do have that concern, the same concern. Moderna, by the way, just got added to the S&P 500, I think. So yeah, $200 billion valuation or whatever it is, it sounds a lot, but again, if they can, for example, use the mRNA to solve some raging cancer problem or something like that, then the $200 billion is going to look like cheap, right? So I don't know much about this company. I really try. Biotech is somewhere where my success rate is really low.
It's where mine is very low because I don't even try to go there. So yeah,
I have tried, and I think my success rate, the only biotechs I've been successful with are what I call medical device companies.
Yeah.
But man, I think my success rate is exactly 0% for drug companies. So it's really hard.
It's talk about, edge of circular competence, or just even not even being able to get an edge at all. It's a fascinating one. Okay, so we've got a little bit of time left here, mate. I would maybe just quickly dive into some personal finance hacks. Some of the things that recently appeared on our Australian Finance podcast. We polled the community to try and get some ways to save money, and some of the people shared on Instagram, Twitter, or Facebook. And one of the things which I thought was pretty neat, which is kind of delayed gratification in practice, which is just 30-day rule. So if you're going to buy something that you really want, obviously not like something that you need day to day, but something big like a television, a phone, a laptop, whatever, wait 30 days and see if you still feel the same. Set a calendar reminder, and then you'll be able to determine if it was an emotional / impulse buy. So that's an interesting one. And another one for our people that long haul flights, or even just flights around Australia, take your own 2-minute noodles to the plane and just ask for some hot water. I don't know about you, but I can't stand the noodles that they give you on the plane. It's been a while since we've had to travel, but that's a little hack that I already knew about beforehand. And there's all the usual ones, like call up your bank, ask for a different interest rate. Each time you get a pay rise, invest the difference rather than spend it, because otherwise it becomes lifestyle inflation. So many good ones here. Meal planning obviously works for people that particularly have a family. And track where your money goes, just some basic ones. So these are some of the picks from our community. I'll put a link in the show notes. We always try and include 1 or 2 of these in here just to kind of bring it back to reality. There's actually a really interesting article quite a while ago now by Josh Brown from Ritholtz Wealth Management, who basically said, if you are an investor, like an investment advisor or something like that, if you can bring it back to personal finance, it cuts through all the noise. And it's so true, I think. So that's why we do it.
And I was going to say,
Mm.
so the two that were there, they're brilliant ones. So, invest the extra from your raise.
Mm.
Here's the problem, Josh Frydenberg is going to hate you for doing that.
Yeah.
He would like you to spend, if you got $200 extra, he wants you to spend 205, and you are telling people to go and invest the 200. Darn. That's like that. So you can invest, but you'll sink the economy. That's all going to be on you, Owen.
Well, I was in his electorate for a while, so he better be nice. But there's another interesting one, which was it's a very unique one. But this couple wrote in and said they've been house sitting since 2017, and they instead of renting or buying a house, they've moved around Australia. It's forced them to live, in a way that's keeping expenses low. And they reckon they've saved tens of thousands of dollars just by living this lifestyle. And they work remotely and do all these types of things. And there's a website that they talked about called Aussie House Sitters. And it's a really interesting way. I mean, it's a particular type of person that would do that. But they said the next 6 months is in Townsville to look after a cat and a swimming pool, all rent free. So there's something for you. If you're out of lockdown, you want to travel around Australia, but you don't want to pay, maybe that's one way to do it. Mate, last thing of the day, we always talk about 2 stocks to watch. I think I went first last time, so maybe you can share the company. Maybe a big surprise for you. Drum roll.
I'm going to keep it easy and short and simple. I'll say that I think, irrespective of all the, I think the noise around ELMO and the fact that, there's a acquired earning, exactly as Owen said, that company's, when I last checked, it's EV over ARR. So enterprise value, which is basically market cap minus cash plus debt, divide that by the annual recurring revenue was less than 4.
That's very low.
That is very low.
For a company that's growing at, in the 20s, organically.
Well, let's say even if it's growing at, let's say it's even growing at 15%, even for that, if this company can even grow at 10% for the next 5 to 10 years, then this would, this sounds like a really, really low multiple. I think it's, is it the highest quality SaaS company you can buy or software company? Probably not. But when you adjust it for the price, I think you're getting a really, really good deal. If you can be patient and let management execute, I think this can turn out well. So I'm just saying my pick would be ELMO. Over to you.
Okay, that's great. I like it. And it's a business that I should probably take another look at. I'm going to do one a bit different, which is not necessarily a company that I'm looking to buy or sell. It's just an interesting business. I talked about PEXA last week, which we've since done a valuation on. I'm going to talk about just a company called Cobram Estate. You might know Cobram when you go to your Woolies or your Coles and you see the olive oil section. If it's true olive oil, if it tastes bitter, if it's true olive oil, it's actually incredibly good for you. And so Cobram Estate, I believe, produces 71% of Australia's total olive oil production. Its farms are measured in thousands of hectares, whereas, say, in Spain, they might be 5 hectares. So if you're thinking about olive oil production, that's the scale of this business. It's responsible for the Cobram Estate and the Red Island brands of olive oil. So you'll see them everywhere. One of the things that I'll give you an inside tip. I'm not much of an olive oil connoisseur myself, even though I'm coming across as one. The extra virgin olive oil, which is the purple label, is the top of the range olive oil from Cobram Estate. You typically pay a bit extra, but if you're making something nice, well worth it. And the business is interesting because it's IPOing today. And it came to the market without giving a reason why it was IPOing, and it didn't set a price. So the market was effectively in free float. And I'm just looking at the ASX website as we speak. It looks like it's currently priced about $1.84. It opened at $1.84. It went up to $1.88, back down to $1.81. This is all in the first couple of hours of trading. And now it's
what's the market cap?
That is a very good question. And I do not have that in front of me at this share price. So I will have to defer to, I'll have to take that on notice. Thank you, sir. So I don't actually know exactly what it is. I should know this.
Doesn't CBA or something else tell us what the market cap is, or they don't? It's just floated today, so maybe they don't.
Yeah, I'll give you some numbers. EBITDA forecast for FY21 is $68 million. But the thing about Cobram Estate, which is the way olive oil and olives are produced, is that they have good and bad years. So you know that that's coming. But Lachlan Bird-Jensen has written about this for Rask Media. He's actually said that it makes it very hard to forecast. So because there's expected seasonality when you talk about companies that are exposed to the environment and agriculture, but this company actually will experience seasonality within a 24-month cycle too. So, this is a company that's been around for, I think, a couple of decades now, and it's not really at break even. So it's a business, like I said, EBITDA is, up in the 60s, but net cash from operations around 18 million. If you take out CapEx, you're looking at about 15, 16 million. So you're left with about 2 to 3 million. They estimate net cash flow in the year ahead will be negative 2 million. So this is a business that's been around for a long time, still got the founders at the helm. Just a business that's interesting. And if you like olive oil, you might put it on your watch list or at least your shopping list. So, and we'll get back to you with the market cap in due course. And that's Cobram Estate. So ASX CBO is the ticker code. So we've got two interesting ones. We've got ELMO and we've got Cobram. If you're on Twitter, say good day to us. We'll tweet this out. This comes out on a Saturday morning at 7 a.m. for the early birds in lockdown. Turns out Saturday's our most popular day to listen to a podcast too across the whole Rask business. So that's quite interesting. Yeah, no surprise there, mate, we've got to say. And if people want to find out more about you and Seven Investing, where can they go?
Oh, they can go to 7investing.com/subscribe if they want to subscribe to our picks and use the Rask code to get a discount, $10 off the first month.
Yep. Well worth the investment.
If you don't want to subscribe, that's also okay. We are here. We'll chat about stuff.
Yeah, we sure will. But yep, I can tell you it's well worth it. If you're interested in investing in US companies, fast growing companies, all different types of companies, well worth the subscription. And if you want to find out more about what I'm doing at Rask, you can head to rask.com.au. That's www.rask.com.au. Anirban, always a pleasure, mate. Thanks for joining me.
Thanks for doing it. I was going to say something that today was a well-oiled podcast.
Well, it was a well-oiled podcast, actually.
Podcast, yeah. Because of the olive oil.
Oh, very well done, sir. I like what you did there. Indeed. Always a pleasure, mate.
Always a pleasure. Thank you.